Earnings from American banks are rolling in this morning. Bank of America, Wells Fargo, Citigroup all seeing some pressure. However, our next guest says Bank of America and Citigroup both posted strong quarters and good outlooks. Here to break it down for us is Mike Clare, Senior Vice President and Senior Portfolio Manager at Brompton Funds. Mike, thanks very much for joining us.
Yeah, thanks for having me.
We're seeing them off for the morning, but overall, you're saying they look pretty good. Let's start with Bank of America.
Yeah, sure. Looking at, Bank of America, I think the results for the quarter were pretty strong. They had a, moderate earnings beat driven, I think, by strength across several of the businesses. So you're looking at like net interest income, which is core lending business, was ahead on loan growth and some moderate expansion in margins. We saw pretty strong capital markets results with strong, trading revenues. And investment banking revenues, notably advisory fees, were ahead by about 20%. Investment banking in the second half, management highlighted, was up about 25% versus the first half. Bank of America, of course, has a pretty strong wealth management business that is performing well. And notably, like credit across all of the banks is performing well with benign credit environment. Credit losses generally sort of down versus the prior year. I think what's concerning the market is like the outlook looks good. Mm-hmm. Guidance was roughly in line on interest income. With Bank of America in particular, they're guiding towards 200 basis points of operating leverage, which is implying that revenue is going to be growing faster than the expense line. I think that's a little bit weak relative to what the market was expecting, and that's driving some of the weakness in the stock today. As we've seen with JP Morgan yesterday, and again with some of these banks today, I think the market is laser focused on expenses, expecting expense efficiencies in 2026 and into later years. We think the reaction is probably a bit short-sighted. I think when you see banks like Bank of America and JP Morgan, investing in the business, they're investing in growth. It's a great environment for banking. Across core banking businesses and capital markets, investing in technology, which should set the stage for cost reductions in the future. We think having operating leverage come in maybe 100 basis points below expectations and then having the stock sell off is probably a little bit short-sighted. And notably, there was, in the analyst call, there was a bit of a feisty back and forth on that as well.
And what happened there? Like, is this a case of expecting perfect, almost a lot like the Mag 7? If you're not bigger and better than what we wanted, then you failed?
Yeah, that's one of the other things we're seeing is, of course, you look at bank reporting over the past year. The results have been very good, and there have been some very strong beats relative to expectations in past quarters. And I think expectations have now caught up to some extent. So when the banks only have a moderate beat, a lot of good things are priced in. You do see some weakness in the stock. But again, we think that's somewhat short-sighted given the positive macro backdrop for banking and the positive outlook for particularly the U.S. economy in 2026.
All right, let's talk a little bit about Wells Fargo and Citigroup and then get a bigger picture. Wells Fargo, what did you like, not like?
So this was, I think, describe it as an okay quarter for Wells Fargo. Generally, revenue, net interest income, drivers of the business are roughly in line with expectations, which is again not enough to drive a positive reaction in the stock. What we like is they've demonstrated some pretty good results on expense management. So their expenses over the course of 2025 were actually flat, which is pretty good in an inflationary environment we're seeing. We're also seeing them sort of get back to balance sheet growth. Of course, Wells Fargo was under an asset cap up until earlier last year. And so now we're seeing them, invest in the business. Their net interest income guidance for next year is resulting in something like 5% growth, with expenses largely in check. We should see loans growing in the mid-single-digit range, deposits, along the same lines there. So it's like an okay quarter for Wells Fargo, but not enough to really drive a positive reaction in the stock.
All right, and Citigroup.
Citigroup we thought was a great quarter. We saw there are a few, one-time items in there, like they announced a loss on the sale of this business they've got in Russia, which was actually announced in December, so it's nothing new. But if you take that out, they had a pretty solid beat driven by momentum across a number of their business lines. One area of Citigroup that we really like is they call it their services business, which is essentially banking for large multinational corporations, looking at cross-border treasury management, payments, and other things like that. That saw pretty good results, up 15% year over year, well ahead of expectations. And management highlighted things like deeper client relationships and new client mandates that are driving that business. We also saw fantastic results in investment banking, with advisory fees up 84% year over year. That's something where we see continued momentum in 2026. Generally, good result for the business.
All right, and just want to talk about I don't know if it's even a potential headwind, but it's been bandied about. It's Trump. The credit card interest rates being capped at 10%. He would like to see that. Is it realistic? And I mean, if it actually did happen, what kind of an impact might that have?
Yeah, I think obviously that's something that's weighing on bank share here. Our view is that this is a little more bark than bite. We don't think this is something that's possible without legislation by Congress, which we think is unlikely. Also think the policy doesn't really make sense. Credit card lending is a highly competitive business. There are a number of players in the market, so we don't think like a price cap doesn't make sense in that business. And then notably, the banks are actually pushing back quite hard on this, particularly Citi, which of course has larger exposure to credit card lending than some of the other larger banks. They have some comments this morning suggesting that having a cap could result in cutting off lending to certain parts of the consumer environment, and then that could drive a significant economic slowdown as consumers lose access to credit. So we think that Trump does have a history of backing off some of these poorly thought out policies. We saw that a lot with tariffs last year, and ultimately we think they're probably looking for someone to blame when it comes to these affordability issues, and the banks seem to be an easy target. No, I don't think that there's going to be a 10% cap on credit card rates. I do think that if there was, it would be pretty material for bank earnings. But yeah, again, the banks are pushing back pretty hard here.
And any other potential headwinds you see for the next year?
No, we think, again, the environment is pretty good for the banking business. Like capital markets, we expect a pretty strong recovery there. The core lending business of these banks looks very strong. And ultimately, we think, an investment in technology today should drive positive operating leverage in the future, particularly with the deployment of AI, which has an opportunity for these banks to really reduce headcount or continue to grow without expanding headcount.
Okay, we'll wrap it up there, Mike. Thanks as always for joining us.
Yeah, thanks for having me.
Mike Clare, Senior Vice President and Senior Portfolio Manager at Brompton Funds.